The major differences between the HHV process and what we are doing today is firstly the size of the companies we invest in. So Hunter Hall have a very storied and excellent track record in microcaps. We do invest in small caps, but our definition of a small cap is 1.5 billion. So we won't invest in companies less than 1.5 billion. We have Hunter Hall prided itself on, I think, stock selection, and they would have a portfolio of the, say, 100 best stocks they could find. We're trying to find the 30 to 50 stocks that work best together. So it's not a collection of best companies, it's companies that work best together. The other difference is we tend to avoid binomial outcomes, and Hunter Hall had some stocks with binomial outcomes, and they often did very well from them, but we tend to avoid those kind of areas, and we would have less exposure to Australia than what's currently in the Hunter Hall HHV portfolio. Ethical has been part of our process since we started our fund, even prior to Hunter Hall joining. So there's no change in our structure at all. We are going to employ the Hunter Hall ethical process simply because it's more formalised, but we have been ethical fund managers since the day we actually started our fund. We've actually sold companies that we thought were unethical, and we're very comfortable with that. So there's no change in our investment strategy, and there's no change in Hunter Hall's ethical requirements. Our fund has 3 goals. 1, capital appreciation. No one invests not to make money, and we understand that. 2, avoid drawdowns. So we want to avoid big losses. Even if there's a chance for a big gain, the chance of a big loss, a binomial bet, we will avoid it. 3, reduce volatility. We think the path from here to here is important. It does actually matter how you get there. Now, the reason for that is I'm going to share a very brief story. I understand Fidelity Investments undertook a study of its Magellan Fund between 1977 and 1990, where Peter Lynch managed it. He's probably the best equity fund manager of all time. And the reason being is he delivered an average annual return of approximately 29% per annum. I mean, just think about that, that's phenomenal. But what they found in their study was that the average investor in that fund lost money. Think about that. The average investor, the fund delivered 29% on average over 13 years, but the average investor lost money. And the reason being is very simple. Humans are very emotional animals. And what they would do is they would put more money in after periods of good performance and take money out after periods of bad performance. And because it was quite a volatile fund, though there were lots of those good periods and bad periods, in the end they all got there, but there was that path. And so what it meant is the average person lost money. And it's easy for us to just sit back and say, well, I would never do that. What kind of idiot does that? That's not me. But this is probably, or that was, one of the world's largest equity funds with more than tens of thousands of investors over 13 years. The sample size can be extrapolated to the bigger population. So there's a problem that needs to be solved. And so that's why we actually do think about volatility, and we do think the path is very important.